Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening and watching.
Great to be here as well. So, we're going to follow up from our last conversation a little bit, and relating it to, I've had a few conversations with clients about buying a house, both clients and a few other friends, and exploring a lot of different ways to do this, especially as it comes to how much to put as a down payment and what are the repercussions for financial independence down the road. So a couple of them were thinking of like putting larger down payments, which means that their mortgage will be smaller, so the mortgage payment is lower, so it fits in cash flow better. Other ones are kind of looking at, well, if we just do a down payment now and we'll kind of keep more invested that's growing for the future. And one of the things that came up from our conversation last time, and I've been thinking about, is for most Americans, most of their net worth is tied up in their home equity. Their primary residence represents the majority of their net worth. So that's kind of the premise for today's conversation. So Trishul, first, does that sound correct as a premise?
Yeah, it does. It does. I think that the thoughts of real estate weighing heavy on the net worth of Americans has also been kind of spooling around in my mind over the past week or so.
Okay. And in terms of mechanics, would you kind of just agree, like, if we have the assets, maybe not to buy a house outright, but to buy a house, you have more than a 20% down payment, you have a smaller mortgage, therefore you have a smaller mortgage payment, fits in cash flow a little bit better. Like that, would that also make sense?
There's some caveats there that I'd probably bring to the table.
So their big question was, should we?
Yeah.
Should we make this larger down payment to lower our monthly payment?
Yeah.
And that's where the conversation didn't quite get off the rails, but it was like, well, 4 or 5 different like caveats and paths started to come forward. And that's kind of what I want to explore today.
Okay.
So given that, do you have like one quick, because I got a couple things, I have a couple things I got to lay out as like, again, a little more mechanical, but anything you want to like insert there as either it's an idea or add to the premise or something that you are going to be thinking about while I'm laying these scenarios out?
Oh boy, there's 2 things. One might derail the conversation, so I don't want to put too much emphasis on it. But frankly, it has been weighing on me a little bit, Aaron. That a large percentage of net worth is tied up in real estate, and that's the primary residence that we're talking about for most Americans. And it based on the rent-seeking conversation we just had, it feels like there's a bit of a house of cards effect going on there with that. So I think the initial question in my mind is that even a good decision to tie up one's net worth in real estate? That's a whole rent versus buy decision, frankly. And but to address your actual point, which is also a decision of how much down payment should you put, meaning how much gearing do you want in this investment, like how much leverage are you going to take on? I think one thing just to kind of think about at a high level is there's always an opportunity cost. If you're putting more down, yes, your monthly payment is going to be lower, but you're locking up more capital, so that means your overall investment return may be lower. So that extra money that you put in the down payment could have been growing in the market at a nice clip. So there's something to think.
Okay. So those are all good points. I want to kind of address those And before anyone kind of leaves the conversation, I think the super quick advice is buying a house is a commitment to location more than anything else. And I'm like, that's my thesis for today's conversation. I don't even want a response from you yet. So like, I'm going to try like lots of things to kind of lay this out. So first, I like that idea of that rent versus buy conversation. And I have seen enough studies with kind of enough different assumptions that it's like you change one assumption that says this, you change another assumption that changes this. But I'm going to say roughly, if you have, we might have to use examples, but like, let's say rent for a family, because we're in the Bay Area at a particular place, is $5,000 a month. And if they were to buy a place, it's going to be $7,000 a month. And we'll do $1 million home at 20% down payment is 200 grand. And I'm going to make up a lot of numbers. I forget these, but very roughly, if you were to rent for your entire life, which the assumption in these different analyses is that $2,000 a month delta that you're not paying towards a mortgage because you're only paying rent, you have to save and invest that. And you save and invest that over the 30 years that you'd be paying a mortgage anyways. And is that savings worth enough to then pay your rent from year 31 on for the rest of your life? Along with the money that would have been the down payment also grows over the next 30 years. And so it's the 200 grand as the down payment plus the 2,000 a month grows up to just kind of cover your rent, cover your housing cost. Yeah. And it'd be like your rent minus what the property taxes and expenses you still had. But that's the rough idea in these analyses is if you were renting and you have the discipline to save instead of buying, you still have a place to live. So after 30 years, you now have a home with no mortgage that provides the place you live in, that provides your residence, or you can take this liquid portfolio, take income from that, and pay rent somewhere else for the rest of your life. So that's kind of the basis of this kind of analysis.
Sure.
And again, we change a little assumption here or there, the real estate growth rate, the mortgage interest rate, the ability for that $2,000 a month to save more over time, the rate of return on that big lump sum. Like we change this a little bit, could point it one way or the other. But my take is that it's actually close enough that I'm actually kind of agnostic in terms of just the assumptions and the math in those types of studies.
Yeah.
Okay.
Right.
Realistically, this is where kind of the most Americans kind of thing comes in. People have a rent of $5,000 a month aren't saving that $2,000 a month delta just to cover housing in 31 years.
Uh-huh.
They might be saving it, but they might be saving it for financial independence. They might be saving it for something else, or they're probably spending some of it and saving some of it. But that ends up kind of defeating the purpose of that particular analysis. And my take there is more of a guess. The reason the majority of Americans have the majority of their net worth in their home is that mortgage almost acts as a forced savings. They do a great job of paying their mortgage over 30 years and building up this home equity because the discipline part is easier. They have to pay their mortgage or they get kicked out. So they make sure they pay the mortgage. Whereas that $5,000 a month rent, so that's why there's some inflation there, but like that delta of like $2,000 a month, not as much discipline saving that. And so that's my guess why in practice, most Americans would not be able to take that down payment, invest for the future, save that delta, and then still be able to rent for the rest of their life.
Yeah.
Okay, so that's kind of my guess / take there.
Right.
Okay. Okay. So do you want to interject anywhere there? Like either my meta analysis of the rent versus buy, and or why I think real estate is a disproportionately large asset in most Americans' net worth.
I largely agree. And I'm concerned at the same time.
Okay.
Just a little bit. Yeah, so the rent versus buy scenario that you laid out, it does make sense. You have an opportunity cost of, some extra money that you may pay on the mortgage or to own a property, and you can take differential when you're renting. And if you are prudent with that differential and you let it grow, it can provide you with a rental subsidy after a certain amount of time for your retirement. I've also seen it from the scenario where there's this notion of like a break even, right? If you rent or if you plan on owning the home for a certain amount of years, the scales kind of tip towards the home being more efficient. But if you plan on moving, in the next few years, then renting will likely make more sense when you add in transaction costs and things like that.
Yep.
The other thing I kind of see, it feels like you're right. There's this behavioral concern that if you leave it up to individuals to decide what to do with that extra money they may be saving by not owning a home, they're not likely to put that money towards the right bucket for their future stability. And it does end up being put to work in the equity of somebody's home. However, I feel like that leads to a prisoner's dilemma type of situation where, yes, at the end of the day, Americans are left with this equity in their homes, but in my mind, it doesn't seem ideal that it ends up that way. It seems like a less optimistic or a less a less opportune outcome than it could have been otherwise had we had other behavioral issues more under control with how, I guess, Americans, maybe other humans in general, tend to operate.
Okay, so I'm going to add some extra layers in here.
Yeah.
Because this is not complex enough.
Sure.
This is a little more anecdotal. I haven't seen as much research, but talking to enough both other advisors working with clients and client experiences, I do believe this. Renting, like you said, gives you the flexibility to move in a way that owning a home doesn't as much.
Yeah.
That flexibility to move tends to also correlate with the ability to change jobs. And so I do think there is a benefit that no analyses can quite capture, that if you continue to rent and you're willing to be flexible on your location, then you will see greater lifetime income. Because pretty consistently, when you change jobs and change companies, you're more likely to get a raise that would be greater than if you stayed at your prior company.
Yeah, that's a great point, Aaron. Yeah. And
so renting tends to allow income growth greater than any assumption we would make, because you're never going to assume that someone's income is growing greater than inflation or even greater than an equity rate of return in this kind of like rent versus buy analysis. But I do think this plays out. And being in the Bay Area, I use the example all the time of if you're working in Palo Alto and you want to take a job in San Francisco, without traffic, that might be a 30 to 40 minute drive. With traffic, it's hour plus. And like, people don't want, if they already live in Palo Alto, they don't want to take the job in San Francisco. Yeah. So they restrict their employment pool. They restrict the potential job openings that they're looking at. But the flexibility to move by renting does kind of allow them to grow their incomes. So that delta could actually become even greater if they're willing to.
Yeah.
On the flip side, I do see it play out where once couples have kids and they know the school district, so kids get to about kindergarten age, and they know the school district they want to stay in, that tends to give them a little more confidence that, you know what, we're more likely to stay here for the next 6-7+ years than I am to continue kind of changing locations for job purposes.
Mm-hmm.
So that tends, it's, I don't like old-fashioned tropes and like rules of thumb, but it has played out anecdotally that once you have kids, you know, put down roots and like kids go to school, like, yeah, it's probably a good time to buy a house.
Yeah.
It's kind of worked out like that.
Well, okay, so I think there's some balancing that we have to consider because, there's certainly been some secular changes in employment in general, right? It used to be you graduate, you get a job, you work at X company for the next 30 years, you move up the ranks, and that you're localized to a particular place, right?
Probably 20, 30 years ago, but sure.
We're the last generation, right?
Past that.
Yeah. But the paradigm now is there's a lot of incentive to switch jobs every few years, right? And there's a lot less loyalty to a particular firm. You're not going to lean on that firm for that pension, by sticking around for decades.
I think we also have seen that there's a lot less loyalty from companies to employees. They will lay off to meet shareholder requirements and kind of improve stock price. So this is the, like, I want to say like the dirty side, but it's like, this is like the way capitalism works, that you have a job market. This behaves like a marketplace. If you're going to lay people off, people are not going to show loyalty back, and they're going to job hop as soon as they get the opportunity. So in good times, people are leaving on their own terms. In bad times, people are being forced out on the company terms.
Yeah. So I think a lot of it has to do with, the efficiencies we've seen plow through, the employment market, largely driven by capitalism, right? It's a lot more efficient to have more of a nimble workforce that scales and shrinks rather than have something very steady. Because look, technology is evolving so quickly, things are moving so quickly. The other wrench to kind of throw in there is that a lot of more people are being virtual, so they're not even tied to a particular location. So even if you move to a particular city to work at a particular company that's high cost of living, for example, if your job turns virtual, you may be scratching your head on, do I really need to be in the Bay Area? If I can do the same type of work from a lower cost of living city.
That is one thing that my clients and a lot of people I talk to do have, the conversations we have. So there's a lot of tech workers who can do their work from their laptop, location independent. And I want to try to not fall into like the trap of like staying in my silo, staying in my bubble. Like, I'm trying to acknowledge that there are probably more Americans that do need to go to work than can work from home.
I was going to say, what does the GPT say? What's your high or lower on this?
I feel like every service, like every hospital, restaurant, retail, factories, farms, almost every service that's like lifeguards, WAG hotels, the pet boarding, like the hotel that you stay on vacation, Disneyland employees. Like I'm trying to think of like just things I'm doing over the next few months, and there's more people who need to work at that location than the tech employees I can think of who can work from home.
Okay. Yeah. You're kind of right. You're pretty much right. So 13% are full-time home, but 40% have some sort of, up to 40 have some sort of hybrid model or, not fully at work. So 60%,
40% is actually higher than I thought. So
Yeah.
Okay.
So 40% is some sort of remote version of work where maybe a few days in office, few days home, or
Yeah.
fully. Yeah.
Okay. Okay. So let's go. So anything else going on like job market capitalism before we get back to buying a house?
Well, I was going to say, so a lot of these assumptions that we're talking about are thinking about a paradigm, or were based upon a paradigm that was certainly true 30 years ago, but things are shifting. And so my personal take is, I don't think they're shifting in a direction that's ever going to go back to where we were. I think the trend towards virtual is going to continue. I think the
Okay.
trend towards people hopping around is going to continue. I think the
Okay.
trend to being less loyal to employees and companies being less loyal to employees and vice versa is going to continue to increase. So I think these are trends that are heading almost monotonically in that direction.
Okay, I would agree with that. Okay, so renting allows more job flexibility and probably greater lifetime income.
Mm-hmm.
And this is one of those things where when you do any kind of study, like increasing lifetime income changes everything so much more than any like rate of return on equity that you could ever see. This is where like why the value of a college education plays out. Like if you get a 10% starting raise in your early 20s by having some extra education, that compounds, where we're talking the difference between like $2 million in lifetime earnings versus $3 million in lifetime earnings.
Mm-hmm.
So something on that scale where you're actually earning an extra $1 million over a 30 to 40 year working career.
Yeah. The caveat I'll put in is for it to actually flow through, you want your savings rate to either increase or at least stay flat as a percentage of your income.
Percentage of income, yeah.
Or hopefully increase because you're keeping lifestyle creep under control.
Yes. So that's what I say. Like lifetime earnings makes everything a lot better.
Yeah.
Usually increasing the ability to save more.
Right.
Both as a raw dollars as the same percent, both saving 15%, the higher income saving more. But usually because there are enough expenses that are the same across income levels, like utilities are going to be the same. A lot of things that like clothing costs the same kind of thing. You can manage that, which allows you to actually likely have a higher savings rate, even on a higher income.
Yeah.
So, okay. So yes, job flexibility from renting can help with lifetime income. That helps a lot.
Yeah.
Another kind of, I explained this to a friend, and I liked it in the time, and I'm still not sure if it's I'm on a solid foundation, but I was trying to describe when you have that higher mortgage payment, that say $7,000 a month in our example for 30 years, it's kind of like taking the entire amount that you'll spend on housing over your lifetime and condensing it down to 30 years. Kind of.
Yeah. Okay. I'll go with that for a bit.
So
or at least subsidizing it.
Yeah, it's the idea like that.
Because taxes and maintenance and insurance and other things.
But you also get like mortgage interest deductions that kind of offsets it a little bit. But yeah, I'll say it is kind of, that's why a mortgage pretty consistently, and this actually does play out in terms of real estate markets, as interest rates change, that does affect rents, because we do see, like, if interest rates rise and property values rise, it's more expensive to buy, more people will choose to rent. But if the cost of buying comes down, more people will buy, so will actually drive rents down relative to it. So we do see pretty consistently buying a house will be a little bit more than renting. And that's kind of also why it feels like we're condensing a lifetime of housing costs into that 30 years time frame.
Yeah, you're prepaying maybe.
Yeah,
some
because once you pay off the mortgage, your housing cost goes down dramatically, whereas just property taxes and maintenance.
Yeah. So again, the caveat is that's kind of true. However, it's less true if you are that savvy renter who invests the differential and is also prepaying their future.
No, this actually still works. It's they just like there's like a mental accounting, like
yeah.
Well, you're right. You're right. It's like yes, if they both have the 7,000 a month that they're allocating towards lifetime housing.
Yeah.
One of them has it in a liquid stock and bond portfolio that's going to pay their rent from year 31 on. The other has it in home equity.
Yeah.
And that's kind of like what that analysis is like. Would you rather grow your net worth via a liquid stock and bond portfolio or via home equity?
Yeah.
And that's a bigger conversation that we might get to.
Yeah, well, we did talk about it a little bit last week, where one relies on rent seeking for it to work, and the other relies on productivity increases.
So, okay, we'll get to that in a minute. But I think I got.
Okay, I won't steal thunder on that.
Because I'm still trying to get back to this idea, like, should they make a larger down payment? And because from a math perspective, I don't think it matters that much.
Yeah.
I think it's the same idea of if they have a lot of like the 5,000 a month rent, 7,000 a month house, that's kind of assumes it's the same house.
Yeah.
But if they put more in as a down payment, they are bringing that rent down. So they still had the like 30-year time frame, but they took that big chunk to also like could have gone towards lifetime housing and put it in there just all the way at the beginning. So it does feel like they are leaning more into this home equity. And among other things, one is it's harder to have that job flexibility. It's not impossible. It's harder. Two, it's kind of a question like, why do they need that lower mortgage payment? Are they trying to stretch for a house they shouldn't be going to anyways?
Right. Yeah.
And then kind of three is like, are they going to live there 30 years? Because we get into in addition, like all the assumptions we've done is real estate grows at some rate of return, stock and bond portfolio grows at some rate of return, and we've got long enough time frames we can kind of ignore volatility, but always ignore it. But if we get into anything short term, there's a lot of volatility. And so if they wanted to try to move within 5 to 7 years, and the value of their property goes down, then they actually might be like compounding the pain kind of thing.
Yeah. I mean, so there's a lot of reasons why if you are only going to be living there for a few years, it may not make sense to own. And the big one is, your risk of short-term movements affecting you are greater, because just like when you're investing in the stock market, if your horizon is very short, you're going to be subject to lots of movement. But the longer your investment horizon, the more chances for things to recover and smooth out. But we turn back to some sort of mean.
So the flip side on this is kind of why I want to have this conversation. So I haven't quite figured this part out. The flip side is actually, so the other part of like the 7-ish year time frame for buying a house is cost of transaction costs. Like that was kind of eat into it. But also a smaller down payment has a larger leverage.
Sure.
And so roughly if we have a $200,000 down payment, $1 million property, real estate goes up 10%. So your equity goes home value goes from 1 million to 1.1. Your your mortgage is still 800 grand. Your equity now goes from 200 to 300. So a 10% return on the property, you have a 50% return on your equity.
Yeah.
It works on the flip side, where if it goes down from 1 million to 900,000, your equity dropped from 200K to 100K. And so that negative 10% meant you had a negative 50% on your equity.
Yeah.
So more of a down payment does reduce that a little bit. Where if you had a $500,000 down payment, so kind of, and a $500,000 mortgage, it goes up to from 1 million to 1.1, your equity goes from 500 to 600. So you have not gotten the same amplification, but if it goes down from 1 million to 900, your equity went from 500 to 400. So you only had a 20% loss instead of a 50% loss. So there's still some amplification. And so like really quickly, if you were trying to think of shorter term, less than 7 years, I'm trying to, which is the bigger effect? Like having less money there, but more leverage impact, or more money and less leverage?
Well, okay. So a couple things. I get the feeling the bigger concern is if it's, okay, so let's even mention it though. So the back of the napkin number you might hear is a 7-year break even, where if it's less than 7, you may want to rent. If it's more than 7, you may want to buy. It's a little bit of a rule of thumb, but there's a bunch of caveats there, which we can go with for the moment.
I'd love like 7 to 10 years. Like that's the narrow part of the range, but yeah.
Right. Yeah. But the point is, if you're shooting for that shorter horizon, would putting a higher down payment help reduce your risk? I think in my mind, if you're shooting for the shorter horizon, this may not even be a question to be thinking about. You should go back to thinking, should you be renting? And the other thing I'll kind of say is the difference between 20% down and 30% down is essentially, if you're shooting for a longer term horizon and you're letting averages work themselves out, you're taking less risk with the 30% down because you're locking up more money. So your overall return over that period is going to likely be lower. And this is one of those things, for example, where somebody may be more comfortable shooting for more bonds than stocks, right? That type of individual may want to make this type of trade-off. They're concerned about the volatility of the price movement in the event that maybe they have to liquidate early, something like that. It's, for example, why those choose to have a higher position to bonds as they approach retirement to reduce sequence of returns risk. So that's the moderation that you're kind of thinking about. However, the mindset again of the home is, if you're thinking about something over decades, then the law of averages should work themselves out such that you probably do want to target something closer to that 20% down and let the averages work themselves out in your favor.
Yeah. And so the other factor that I think came into the recommendations I was making, so there's probably two. One, pretty consistently we see the lower down payment. Once you have a mortgage payment, your mortgage payment stays flat with a fixed mortgage rate. Your income still likely grows. It might only grow with inflation, but maybe a little bit if you have promotions. But like your income still likely grows over that same time frame.
Yeah.
And so while that $7,000 a month might feel tight, it only gets easier over time.
Yeah.
And so when you have the smaller down payment and you have more assets outside the home, if you wanted to relocate 10 years down the road, any bad effects from the home equity to kind of doing leverage, you probably have enough outside assets to be able to help with that down payment. And so I think having that forced savings of $7,000 a month and the outside asset tends to help your overall net worth decades down the road. And it's because in our scenario where if you had the $500K down payment and it brings your mortgage payment from $7,000 down to $5,000, which you can kind of fit in cash flow, to make up for that, the opportunity cost of that $300,000 growing, you still need to save that $2,000 a month. You still have to fit that in your cash flow. So it's one of those things like if you're going to do the large down payment to reduce the monthly mortgage payment to be the same 20 years from now, you have to increase your savings to what the mortgage payment on the smaller down payment would have been anyways.
Yeah, frankly, I'll say a couple things. But the high level in my mind is I don't think it's going to be life changing in either way, in either direction.
Well, so the math says that, but I think behaviorally it is life changing.
Well, for example, we're talking about a $1 million house, right? An extra $100K down payment, right? And that extra K, the opportunity cost is it grows inside the home, right?
So in my example, I was doing $1 million, $200K down payment or a $500K down payment. So like this is
20% versus 50%.
50%, yeah.
Oh, okay. I wrote down 30.
Right.
Okay, so 20% versus 50. Okay, that is a. Just kind of thinking about it at a high level, imagine you have person A who puts 20% down and person A puts 50% down. Now, person A has that extra 300,000 growing at the market rate, right?
Yep.
In my mind, the person who puts the 20% down is probably going to end up with more money at the end of 30 years, right?
Because they're paying more on their mortgage, so they have more of their income going to that. Whereas person B,
and not only that 300K is growing at a faster clip.
Correct.
Yeah.
And that person B just less likely to be saving enough to make up for that lost down payment.
Yeah, so the way I kind of imagine it is some person A is like the stock investor who's like 80-20, 80% stock, 20% bonds, right? And the person B is more like the 50-50 guy, right? Okay. So they're going to have a smoother ride potentially, but over decades, they're going to fall behind to the point where they probably will never catch up to person A. Right. But they'll enjoy more peace of mind along the way.
That's a great point. So part of the reason why this did come into play is the couple with the larger down payment and the smaller cash flow. If they both work, if one of them gets laid off, they can still easily fit that mortgage payment in the income of one of them. But the larger down payment with the larger monthly payment on a smaller down payment, they're kind of dependent on both incomes. Now, I know the caveat is they can use that 300K excess as a reserve, so they have to kind of keep a bigger cash reserve.
Yeah, right.
But there's a psychological difference of I have money invested. I can tell myself I'm never going to touch it. I can just let it grow for 20 years. Yeah. My job pays my mortgage.
I see this similar to the trade-off of there's some people who prefer to self-insure, right?
Yeah.
And some people we prefer to give up upside for a feeling of security. Yeah. So I think that's the trade-off we're talking about here.
And your example, the more aggressive investor versus the more conservative investor makes a lot of sense. They don't want that volatility. They want that peace of mind.
Yeah. Like
So
in my mind, I'd be person A, and I'd be like, okay, big deal. I get laid off. I got this chunk of money
yes,
growing, and I'll shave off money, until I have a new job, something like
yeah,
that. But I can understand that some people, they want the comprehensive insurance, right, on their car, because
yeah.
if something goes wrong, they don't want to worry about it. They're already stressed out.
That's a great perspective. It's the that's a really good perspective. The smaller down payment is a net worth maximization strategy.
Yeah.
The larger down payment is smoother ride, less risk.
Yeah.
That's
Right.
that's a great perspective. Yeah, I like that framing.
Yeah.
And so like that's why I kind of accidentally most Americans have been on the net worth maximization strategy with the small down payment, and that's why their home is their biggest asset.
Yeah, well, so I'll also say this though. We know, for example, that if you're investing in stocks over decades, your risk goes down. Your sequence of return risk goes
Yes.
down. Your averaged out volatility goes down. Your expected return balances out, right?
Yeah.
And if you're owning a home over decades, you have a 30-year mortgage, literally 30 years, 3 decades. It's quite likely that your risk will average out to average expectations.
Yeah.
And from that standpoint, a 20% down payment is sensible, even though it is higher risk than the 50% down. Over that long of a time horizon, it's I understand why that's closer to the standard. It makes sense.
I like that. Which kind of gets us back to the buying the house is the commitment to location more than trying to grow your net worth, because you can do it either way. It's when are you ready to make this multi-decade bet kind of thing. I don't like phrasing it as bet because there's other ways, but like, yeah, like I'm changing my plans from every like a 3-year time frame to a 20-year time frame.
Yeah, yeah. It's a good point. For example, you do get other behavioral benefits by owning the home, right? It's your land, it's your
Yeah.
home. You get to decide a bunch of things that you probably can't decide if you're renting.
Yeah.
And you can't get kicked out, or your rent payments can quadruple, right? So you get a
Yeah.
lot from that. But at the same time, you are committing to this location. Probably for decades. I'm pausing a little bit because there is a strategy where you get to start a home and then you upgrade
Yeah.
to another home in your next city and blah blah blah. But so
And again, because of the leverage that like that 20% down payment, if your property value goes up a little bit,
yeah,
that can make up for that housing for those transaction costs, and your 200K down payment turns into a 300K down payment on the next property, which can also be a 20% down. So that's how you can go from 1 million to 1.5, assuming your income also grows to now afford a $1.2 million mortgage instead of an $800,000 mortgage.
yeah. So I'm hesitating a little bit because intrinsic behind the whole real estate question in general is the notion that real estate prices will increase above and beyond CPI at a.
I actually, well, I don't think that's a necessary assumption. I agree that's probably not a safe assumption. I think the leverage balances that out.
Not really. Not really. Because, okay, so you look at the long-term expected return of just real estate as an asset class in general, and about half of the return comes from the income that the real estate can potentially generate, and the other
Yes.
half is capital appreciation. If capital appreciation is zero, then that's half your upside.
I don't think capital appreciation is zero, I guess I'd say.
Well, that's what I'm saying. for capital appreciation to be above zero, then real estate has to appreciate above and beyond CPI.
I see what you're saying. Okay.
Once you look at inflation adjusted returns.
I see.
Okay, we probably said a lot right there. Maybe we should break down.
Okay. So I agree. So this actually comes into one of the quick phrases I have with people looking at rental real estate. If they have a chunk of money, do I put it in a stock bond portfolio or a rental property?
Yeah.
The way it plays out, it's a little anecdotal. The way it plays out is the rental property generates rental income, and it might be neutral at the beginning, but at some point it's likely a positive cash flow because rent goes up with inflation and their mortgage payment stays flat.
Yeah.
They don't reinvest that rent in the next property. Because it's kind of hard to take 1 month's worth of rent and buy a new property. The way a stock dividend, it's very easy to reinvest in another share of stock.
Yeah.
So most likely people will take the income. It helps supplement their lifestyle, especially in their 50s, kind of like a pre-retirement age. Whereas stock and bond portfolio did a pretty good job of leaving that alone and just letting it grow. And they're not going to touch that until they stop working. Yeah. So a little bit extra income in their 50s, kind of by choice. That cap rate, that 3% of the property value being rent, tend to be lower than a 4% withdrawal rate from a liquid portfolio. So it actually tends to be less income in their retirement years. But that stock and bond portfolio, they'll either spend down a little bit or kind of stay flat. Whereas, now this is one of the assumptions that we can get to, the principal of the real estate, if going up, tends to be a larger legacy asset. This is what I've seen, and this is what we're talking about. I've seen this play out with enough people, of enough situations where real estate tends to be less in terms of retirement income and more in terms of estate left to heirs because of the way that those mechanics.
Right. So sorry about that. Okay. So caveats, right? Caveats.
Yes.
Here we go. If you look at just real estate investing in its pure sense, it's not like an individual buying a single property, but more like a real estate ETF, right? Okay. Where things are averaged out and you get something that smooths out the risk of smooths out the idiosyncratic risk of just picking one property and guessing wrong, like stock picking, right? Yeah. So if you compare,
that's a great, buying a single property, is like buying a single stock.
Yeah, it's actually buying a single private equity investment that you cannot liquidate on a dime, and you're stuck into it, given all of the bureaucracy that goes with it, right?
Yes.
So, but in its pure sense, you can invest in a basket of stocks, right, and smooth out all of that risk of one individual thing pulling you down. And you can do the same thing with real estate, right? In its pure sense, you can buy a basket of real estate companies very cheaply and an index type of portfolio known as our real estate ETF, index ETF.
There's also a real estate investment trust, a REIT.
Yeah, REIT. Yeah.
Yep.
Okay, so now if you look at the returns of both of these asset classes historically, now looking backwards, they've actually been kind of similar.
I agree. We've seen that.
Interestingly enough, it makes sense because when you look at a stock portfolio, for example, intrinsically you have capital that's being put to work on a levered basis, meaning companies have debt, they have equity, they have if you kind of look at them, a good ratio that's kind of common is for every $1, you have like $4 of debt. For every $1 of equity, $4 of debt, right? That's similar to that 20% down that you target on a real estate investment. So similarly, with real estate, you have that 1 to 4 equity to debt ratio. So you have the similar amount of leverage baked into these two asset classes. So
this is why
over
we're
time,
seeing real returns or inflation-adjusted returns on the scale of 6 to 7% for both real estate and stocks.
yeah, so that's typically what we've seen over looking back historically. Now, interestingly enough, that return for stocks makes sense because people are locking up money on a levered basis, and companies are going out and trying to make more money with that money that's locked away. And the reward is the capital appreciation that we see and the dividends that flow back. And if you look at those total returns, you get after you back out inflation around 7%, something like that historically.
So I think this would be important. Like stocks on average, let's say it's a real return of 7%. It's probably like capital appreciation of 6 and dividend of 1. So on average, right? Like
something like
S&P
that. Yeah,
500 has a dividend yield of like 1.5 ish.
1.8. Yeah.
Yeah. So, but in real estate, if it's a 7% real returns, again, inflation adjusted, it's something like 3% rent, 4% appreciation historically.
Something like that. Well, okay, on a real basis, like 3%, potentially once you back out inflation, because about 4.5% is the change in value of real estate historically, right?
Okay, so we're saying that. Oh, sorry, I'll let you finish because I want to double check my math here.
Yeah, so basically, real estate as an asset class, the price of real estate, before you factor in inflation, goes up about 4 to 5% a year, right? Year after year on average. If you back out like a 1.5 to 2.5% inflation rate, you take out 1.5 to 2.5, take out 2% inflation on average historically, you get down to like a 3% real return on real estate after inflation.
Is that? But that's just the appreciation.
Yeah, that's a capital appreciation. Yeah.
Okay. Yeah. Okay. So I think we're saying. I might be a little higher, but the real estate total return is a combination of rent plus capital appreciation.
Well, it's plus capital. It's plus levered capital appreciation. So that's where it jumps up higher, right?
Okay. That's good. That's a great point. Okay. So, and on stocks, the return is
already
after
levered.
Leverage, kind of. And on real estate, the return is before the leverage.
Yeah. So, but you can factor that in and come up with your return on equity, return on capital invested, right? Okay. So my main point is both asset classes historically have performed similarly, right? Where on the real estate side, you have income coming from, returns coming from income, right, generated by people paying rent. And you have another portion coming from capital appreciation, meaning real estate increasing in value above and beyond inflation, above and beyond the rate of inflation. And okay, so here's my so what, right? My so what is, yes, that's been true for the last generation, but for both of these asset classes to perform similarly over the next generation, we have to assume that real estate will have some sort of capital appreciation above and beyond CPI for that return to be attractive. And that's where my concern actually comes into play with real estate as an asset class.
Okay. So is your concern now kind of going back to if we don't have the population growth, then we could build enough housing to keep up with I guess technically a declining population?
Yeah, so here's the thing. Houses do stick around, right? When people die, the houses are still there. And what's happened over the last generation is housing prices have increased well above and beyond the rate of inflation. We mentioned, about 1% or 2% higher per year.
Yeah.
And that compounding effect has led to this quagmire where in the past, somebody had to spend 15 to 20% of their household income on their home, their primary residence. And now that number is closer to 40 to 45% on their primary residence. And that has happened because real estate created above and beyond the rate of inflation.
Okay.
that 1 to 2% extra. Now, for that to be true for the next generation, meaning for the return of real estate to match the return of stocks, you would need that extra appreciation, meaning the average home price or the average household will need to spend close to 80% of their household income on real estate.
Okay. So this is like I don't know if this would be the right effect, but we over that same time frame, we have seen wage growth more or less match inflation.
Yeah.
If we had a period where wage growth outpaced inflation, would that create the demand to kind of offset that?
If. That's a big if.
I acknowledge that, yes.
So,
when you first said kind of housing has increased from 30% of household income to 45%, it's because, again, housing has gone up faster than the household income has gone up.
Yeah.
Because household income's been equal to inflation, whereas housing has been greater.
Yeah.
And so we could see if wage growth and incomes can go up greater than inflation, then housing as a percentage of household income could come back down to 30, but still match or outpace inflation.
Okay, so here's a bunch of things that have to happen for this scenario to play out, okay? So first, the actual supply of homes needs to constrict or stay the same, right? Because a part of the reason why the price of homes has been increasing above and beyond the rate of inflation is the demand for homes have been increasing because the supply of homes is not kept up.
Yes.
Now, we know that if population starts to flatline or even go down, then that's another force you have to counteract, meaning this is more friction for housing prices to go up. At the same time, we've seen that housing prices have gone up because of free liquidity from the government to encourage prices of homes to go up. Right.
Okay.
A large reason why these housing prices have increased at the level they have is because the government has pumped in money to inflate the price of housing. So the government has
form of a mortgage interest deduction.
Yes, and lower interest rates in general, right? The Fed keeping rates low also provide an effect that incentivizes people to buy, which increases the prices of homes. So to keep this house of cards afloat, you need the population to either stay the same or increase. You need wages to increase on a real basis.
Yes.
You also need the government to keep pumping liquidity. This is the number one assets that Americans have. If they don't keep this house of cards afloat, then this is the life savings for the average American down the tubes.
Okay.
Now, here's what happens if all of that isn't true. Then the average wealth of the Americans who are tied up in real estate starts depleting and disappearing.
Okay, so I guess I think that all of those are actually fairly viable.
Viable, meaning possible to be true.
I think they actually are more likely to happen than not over the next generation.
Okay. Let's go through each one. So you think population increases are more likely to happen than not?
Yes, in part because of immigration. Okay. I think that again, this like me being super optimistic because I just watched the Olympics. I do think that as a country we'll become more and more okay with increased population, and the combination of population and organic population growth will still continue to increase. So yes, I do that again, I acknowledge me to be optimistic, but I'm actually the most optimistic about the population side than the other two components.
Okay. So I'm going to share my screen, which is, I think we showed this on the last conversation. I hope I shared the right screen.
Okay.
Okay. So from 1980 until now, the population has jumped from 225 million to about 333 million. right? That's
Okay.
a 30 to 40% jump, something like that.
Okay.
To get that similar return, we would probably need a similar change in population over that period, right?
Okay.
So, what's the expected U.S. population in, give me 40 years from now?
64.
64. Okay, so basically we're targeting 300 and what are we at now? 330 million, 40% more than that.
It doesn't want to give you an answer.
I'm gonna send it again. All right, here we go. 410 million. You might be right on this one, Aaron. What's
330?
330 times 1.4?
That'd be like a 24% growth.
462. Okay, so we may get there. We may.
Okay.
We may.
Okay. I am most optimistic about that one.
Okay. All right. The next one is wage growth on a real basis, right?
I'm least optimistic about this one.
Me too.
I'm slightly optimistic because I do think that there's going to be something where, like, because the job market, we're getting to this stage of like just employees being fed up kind of thing of like we've seen how much stocks have grown. Like we have good data, like there's enough publications, like it's the workers know what's happening. And we're seeing that like capital and stock prices are increasing significantly greater than wage growth. And I think that there will actually be on the demand side of employees greater levels of income. That's again least optimistic, but still technically optimistic.
So why would employers pay employees more on a real basis?
This is second level. So I think that they'll start to realize that they can't treat their employees poorly. That that the companies that would treat their employees well do better. I think that'll actually be enough leadership at enough companies that'll show if you treat your employees well, you actually get better results. And instead of trying to keep labor costs down as much as possible, we're going to try and keep labor happy, and stock prices will benefit. Like there will actually be a financial reason for them to want to do this.
This is probably a big conversation.
But again, least optimistic.
Yeah,
but I'm painting a rosy scenario.
I am not optimistic on that at all, but it's probably worth a conversation or something. Like, there's a lot to unpack there, but you know, neither of us are optimistic on this happening. So.
Correct. And then the last one was government pumping money in.
Yeah.
Especially like via interest rates. This one, I'm in the middle. In part because I actually do kind of respect that the Federal Reserve has remained neutral-ish when it comes to political parties. And so I think that I'm not expecting interest rates to drop in the near future from current levels. Like it would not surprise me if we see a decade of similar interest rates. Again, that's not my guess. I'm not predicting interest rates, but we have seen historical periods with mortgage rates in the 5 to 7 range for 20 years. It's possible we see another historical period of mortgage rates in the 5 to 7% for 20 years. Like that's a possibility. So, and I think that the economy and like consumers will adjust to that level, but it would not surprise me if at some point in the future to stimulate economic growth, they do drop them back down. Like, I don't think we'll ever get back to like double-digit mortgage rates. I think there's enough other reasons why the Fed has done a better job than they did 50 years ago. But I do think that we will see, maybe not anytime soon, but another period where mortgage rates do drop below 4 for a slightly extended period before they'll probably come back up again. I think that the behavior of the U.S. government to help its citizens grow their net worth will probably continue.
Yeah. So here's where that prisoner dilemma concern comes into play, because what kind of intrinsically happens when the government encourages investment by lowering interest rates is housing prices go up because lending becomes more favorable, meaning more net worth gets transitioned to the real estate bucket, right?
Okay.
But at the same time, because interest rates are low, equities also go up, meaning more wealth gets also transitioned to the net worth bucket of the wealthy.
So also on the optimistic side, I think in terms of just education to consumers, I think there'll be more people invested in stocks. I think greater percentage of the population will have exposure to ETFs, to the S&P 500.
Maybe, but see, my point or my concern is that when the government encourages the average American to increase their net worth through higher real estate prices, yet encourages the wealthy to increase their net worth through higher equity valuations, I think that hurts income inequality. That's why I see it as a prisoner's dilemma concern, because you're encouraging the average to increase their net worth in an asset class that isn't increasing in value because it's getting more efficient or doing things better. It's increasing in value because of rent seeking.
Okay. I do the same.
Yeah. Whereas the wealthy are increasing their net worth because their assets are going into companies that are becoming more productive and therefore becoming more efficient.
So, okay. So we would need median household to get to a point where the majority of the net worth isn't their primary residence. We need them to be saving and investing outside their home on a more disciplined basis, whereas that home mortgage is that forced savings into real estate as an asset.
Yeah, like in my mind, I don't see it as a big win that Americans have their net worth in real estate.
Okay.
Like, what are they getting in what are they getting for that?
Okay, I see what you're saying. So I now I'm like, am I optimistic that people will save more and buy stocks more as a population?
Well, so not if they're putting all their money into real estate, right?
I still think I am. I think that there's enough. If nothing else, like companies with defaults in your 401k of 3%, like they just, for your first job, you're now contributing to your 401k, and I think there's a little bit more awareness, and I do think that people will start to. Teenagers these days on the internet, I think they know about Roth IRAs. They know these things exist. I think that they're starting to save and invest a little bit more from an earlier age, and I don't know if this. I don't know if this helps wealth inequality, because I think wealthy will still invest disproportionately more in stocks, but I do think that we will see greater household net worths in stocks, at least compared to today.
I hope so. The optimistic in me hopes so. Or there's some sort of UBI scenario that
Yeah.
still allows the stocks to grow, but transitions that wealth, more more equitably, right? I think maybe something like that could help these pressures. But the status quo is most wealth gets put into an asset class that's not designed to increase in value through increases in productivity.
Okay.
And that's my
I,
high level concern.
I acknowledge the point. It makes sense. And so I think I go back to like just it's okay to buy when you're ready to make your commitment to location.
Yeah.
Before then, keep your money invested in the stock and bond portfolio and get your job growth, get your income growth. And then when you're ready to make that commitment to location, do the 20% down payment.
Yeah. And at a high level, maybe think about that Yale model that we talked about, where large institutions have some share in real estate, but it's not the majority. It's like 20%.
Try to keep so try to keep 20-30% of your net worth in home equity.
Yeah.
So okay. Long 70 minutes to come back to like just normal advice that every advisor gives to every client. Invest in your 401k, 20% down payment, fixed rate mortgage. You're good.
Don't buy a bigger house than you need to. So
exactly.
The other friction that we talked about is there were a lot of reasons why it makes it harder to stay in that one location, versus another. And I think overall that can put downward pressure on just real estate in general, right?
Yeah, there's you go back to real estate is local specific, where just like individual stocks, like certain real estate markets will continue to outperform. There's going to be population movement. You're going to see people moving to certain areas. One of like the things in the back of my mind, I worry about tech jobs leaving California and going to places like Texas. It's one of those like, that could actually make a huge difference to a lot of my clients and friends and family. So
yeah. Well, so just I know we got to wrap this up a little bit, but just a bit of risk that's tied to that, or a lot of it is that, if you're not tied to a location with your job, and also jobs are, more work from home, and also there's a lot of efficiencies from being able to build a house in the middle of nowhere and be okay, then that may also put different pressures on real estate over the longer term. Something worth thinking about. Yeah.
Okay. I think we'll wrap up there. That's that was that's about as long. Like that was as complex as I was expecting. Like I knew this was going to be a big can of worms.
Well, I had no idea where you were going with this, with the title that we initially. I think you had thrown it out there last week, but hopefully I didn't bogart the entire conversation in a different direction than you were thinking. Okay, sounds good.
Okay.
All right. Good stuff, Aaron.
Okay. Good conversation. Thank you very much, Trishul. Right.
Thanks, everybody, for listening. Enjoyed this conversation. Do spread the word. Do like, subscribe, and share. Every even like helps, so we do appreciate it. And thanks. Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.